Good morning and welcome to today's webinar, proudly hosted by PPS Investments, featuring our guest speaker, Errol Shear from Sasfin Asset Managers. Sasfin is our partnership fund manager at PPS Investments for the PPS Defensive Fund. And most of you will be very familiar with Sasfin, but perhaps some background by way of introduction. Founded 20 years ago in 2002, Sasfin has grown into one of South Africa's leading boutique asset managers, offering equity, income, and multi-asset class portfolios. Errol joined the team in 2016 and has been really in the industry since 1991, having worked as the CIO of Absa Asset Managers, and before that, spending more than 2 decades with Standard managing their absolute return portfolios. At PPS Investments and within the PPS Defensive Fund, our approach is really in finding a manager through our comprehensive research capability, looking for a manager with a particular skill set and capabilities to successfully manage a particular strategy. The PPS Defensive Fund targets investors looking for low volatility, diversified multi-asset portfolio, still within the confines of Regulation 28. The primary objective of the fund is to outperform the ASISA SA multi-asset low equity category average, while aiming for low short-term volatility and with long-term growth. The investment horizon for the fund is greater than 3 years. We are delighted to have Errol presenting with us today and sharing some of his key insights and wisdom as to what is unfolding in the markets today. I think we can all agree that 2022 has started off with a bang, whether it be the war between Russia and Ukraine, the pandemic, or raging inflation, or even Liverpool losing the UEFA Champions League and the Premier League this year. I think it's all have a profound impact on all of us. But what we need to understand is that there are opportunities in each of these cycles. And today, Errol will share some of those insights with regards to, buying the dip and whether or not how to manage that sort of investment journey. Errol's vast experience and proven track record is well recognized within the industry, and he has for many years delivered upon consistent returns to investors as one of South Africa's leading fund managers. It is with great pleasure that I will hand over today's session to Errol to take us through this journey. And also just a reminder to everyone, should you have any form of questions, please post it in the Q&A session for today. It's with great pleasure, Errol, over to you.
Thank you, Touch. Plague, war, and famine. All we are missing is the wild beast. We are in unexpected times. And we all thought markets would go forever. What happened to Tina? And I'll come back to that. Tina is very important. What are the market concerns currently? Firstly, the plague, let's get over that. COVID, hopefully that is largely behind us. It'll move from pandemic to endemic, in fact, probably has. But then we have war in Europe. Europe is far from us. What difference does a war in Europe make to our investments here in South Africa? We don't have investments to a large extent in Ukraine or Russia for that matter. But Ukraine and Russia, between them, export in an average year 30% of the world's wheat. That has now stopped. So the consequence of that is that there may be food shortages, and I refer again to the famine or the plague, war, and famine. We are going to see hungry people in some parts of the world, certainly in Ukraine and even elsewhere. And it's not just wheat. Russia is one of the world's biggest exporters of gas, of coal, of oil, which is now being embargoed. They're also one of the world's, they are the world's biggest producer of fertilizer. So even here in South Africa, we're going to find the price of fertilizer going up. And that means that even food grown in South Africa, the prices will rise. The price of sugar, the price of wheat, the price of maize, all rise because of this. So this has a major impact on inflation and will disrupt economic growth to some extent, certainly. And then the bigger question is, there's been noise from China. There's been mention of Taiwan. And that is a big fear, that this war escalates, that the world breaks up into different blocks. What happens if China invades Taiwan and America retaliates? We hope not. That's just too scary a thought. And then next, we have the oil price back to the level of the 1980s, slightly lower in inflation-adjusted terms. But in the 1980s, well, most of you have not been around that long. In the 1980s, we had high inflation, very high inflation. Interestingly, also sparked off by a rise in the oil price. And then next we ask, are we going to have recession in the world? Now, I don't think, none of us know the answer to that. Our expectation is for slower economic growth, but there's no question, if you're an average consumer, certainly in Europe, your price of your fuel for heating has gone up, the price of food's gone up, which means you have less money to spend on other things. It will slow economic growth. Even the USA, which is far away, we don't think we'll see recession this year in the States, maybe next year, but certainly slower economic growth. So those are some of the major concerns that we have in investing. But for me, the biggest issue are the two items I have below here. We've had a Goldilocks situation for the last few years. What has happened is that central banks have found out they can pump cash into economies to keep economies moving even during bad times. So during COVID, you had lockdown, people weren't producing, yet they would still pay salaries, they could still spend because central banks were buying debt and pumping cash into the economy. We've also had 40 years of falling interest rates in Western countries, particularly Europe, Japan, the USA, Canada, Australia. And what this means is that for many years, your interest costs were falling. So as a consumer, you could borrow money cheaply and you could spend more. And debt has been rising dramatically. It also meant that technically for companies, the cost of capital was falling. So share valuations rise. The lower that interest rates are, the lower the cost of capital. And theoretically, the higher that share prices will go, certainly on a calculation. Now, this is a wonderful world. You have no recessions, nobody has to work. As long as central banks pump money into the economies, we can continue. During COVID, many of us were not working. We were working from home, maybe not being very productive, but yet we could enjoy the spending power we had because governments were pushing money into the economy. Can this go on forever? I mean, maybe we found the secret to eternal prosperity. Nobody has to work. In South Africa, we can all get social grants and nobody has to work because government only has to print money and push it into the economy and we can all prosper. Obviously, this is nonsense. And this, I think, is coming to an end. This is a major turning point when you end this priming of economies by pumping cash in and return to reality. If you look at global debt has risen on the left-hand scale here to almost 300 trillion US dollars. Debt to GDP has risen dramatically, particularly during the COVID pandemic. Now, we know you can't borrow forever. At some stage, you have to repay your debt, whether you're an individual with a credit card from a bank. When you maxed out on your credit card, you cannot spend money anymore, and the bank starts asking you to repay it. That is the position of governments around the world. Debt is too high and has to be repaid. And to do this, they either have to raise taxes. Higher taxes means there's less for consumers to spend, less for companies to pay out in dividends. It is bad for stock markets. If they don't repay debt, you can have inflation. And inflation also is bad for economic growth. So really, the world between a rock and a hard place, we either need to have higher inflation to bring down the real value of debt, or you have to have higher interest rates, which reduces economic growth. In my opinion, the world will see slower growth in the next year or two than what we've experienced in the last decade, certainly post the great financial crisis. If we look at the Johannesburg stock market, and sometimes I think we focus too much when we invest on looking at the broad parameters. Let's hone in on the detail. If you look at the Johannesburg stock market, the price earnings ratio on a trading basis is 11. If you look back, going back over many years, the average has been 13 times earnings on a trading basis. So at this point in time, the Johannesburg stock market is actually cheaper than what it's been on average. At the same time, the earnings actually are growing, certainly in South Africa, partly because of the commodities boom. So our stock market actually is not cheap. It is discounting. To some extent, troubles ahead. If I look at the American stock market, the S&P, the PE has also come down quite dramatically for various reasons, but it is still on the expensive side of average. You take the long-term average, it's been a 19 times earnings, and we're still trading at over 20 times earnings. But I want to emphasize here, look at the left-hand side of the chart and look at the right-hand side of the chart. During recent years, we've had much higher multiples in the market. Shares on average have been trading at higher prices relative to earnings. If you go back to the 1970s and 1980s, it was much lower. That was a period of higher inflation. If you look back at history, if we are going to have higher inflation, it does mean that markets like the USA S&P market should trade on lower P ratios. There's very good theoretical reason for it, and the historical evidence supports that. So we are of the view that certainly the American market is not that cheap, and also the E. Stock markets trade at multiples of earnings. So we think both the multiple will come down, and also the E, the earnings part, is under threat. Why do I say that? Certainly on the consumer side, if you're the average consumer, you're going to be spending more of your money on servicing your mortgage with higher interest rates in the year or two to come. You're going to be spending more on gasoline to fill your car. You're spending more on food, which means there's less money to spend on other things. That'll affect the consumer-facing companies. And we've also seen skittishness in the markets, which is normally a sign that things are slowing down. We saw Netflix. We all remember the FANGs, these super companies which are going to grow forever. The FANGs, Netflix, the N part of it. Netflix in one day fell 26% when they announced they'd lost 200,000 subscribers. Maybe Netflix cannot keep on growing at the rate it has been growing in recent years. Maybe the average subscriber has just had enough TV. Maybe some people can't afford the monthly subscription on Netflix. The same happened with Meta or Facebook. They also announced that the sign on of new customers, particularly younger customers, which is where the future lies, had declined. The share price fell 35%. So you can see that when you have earnings growth or expectations of earnings growth declining, you can see falls in share prices. So there's quite a lot of risk in the US stock market, particularly given the high multiples of the shares and particularly some of the high-flying growth stocks. Not all stocks, but some of them. Then I want to compare alternative investments. Most of us focus on share investments. Bonds, I believe, have a place in a portfolio. Now, some people say, well, why invest in South African bonds? And the reason for that is that at this stage, I can earn 10% for my clients on South African 10-year bonds. On American 10-year bonds, it is less than 3%. Even though it's risen dramatically, it's less than 3%. So I'm getting a 7% better return on my money on South African government bonds than American government bonds. Now, 7%, you might say, well, America is a more stable country, but 7% per year does compensate for a lot. You also say, well, inflation is high in this country. Well, our recent inflation rate, 5.9%. America's most recent inflation rate was 8.3%. Our inflation rate is actually lower than in America. If I look at the yield curve, and people say, well, I take the risk of bonds. If you compare the rate I get on 10-year bonds in this country of 10% and short-term money market rates of 5%, I'm picking up 5% yield for my clients by buying bonds rather than investing in cash. So there's a strong argument for having bonds in the portfolio. The other asset class we look at is inflation linkers. And there we're getting close to 4% real on some of our inflation linkers. That is inflation plus 4%. So whatever inflation does, we'll get 4% more in nominal terms. So inflation were miraculously to decline, let's say, to 1%. I'll be earning on these bonds, if I hold them to maturity, 1 plus 4 is 5%. However, as is likely, inflation rises, and let's say goes to 8%, my return on these assets will be 8 plus 4 is 12%. A very good asset for our portfolio, as I'll explain later. If we look at the history of inflation in this country in recent years, the Reserve Bank has a target of between 6 and 3%, the two black lines here. And the Reserve Bank has done an extremely good job of generally keeping inflation within target of 3 to 6%, with some very minor exceptions. I would say that of all the government departments, this is the only one which I think is working well. SAA is a disaster, the Post Office, Eskom, most governments run divisions are a disaster. The Reserve Bank, fortunately, has done a very good job of keeping inflation under control. But if I look ahead, the green line here is producer inflation, the red line is consumer inflation. We focus more on consumer inflation. We and our clients are consumers, and what matters to us is the price of the cost of living as measured by the consumer price inflation. You've seen how producer price inflation has shot up. Consumer price inflation is lagging, and traditionally consumer price inflation rises after producer inflation increases. So first, Tiger Oats will buy wheat at higher prices, then they will sell a few months later, once they run down the stock of wheat bought to lower prices, they're forced to push up the wheat price, and we as consumers face the higher price of bread. They also will try and hold back price increases in the short term as far as they can. So there is a lag. But there's no question consumer price inflation in this country is rising and almost definitely will go well above 6%. The petrol price, we saw the increase yesterday. I haven't filled up yet, but I'm actually nervous as to what it's going to cost me to fill up my car next time. But that increase in the petrol price will only be measured in the month of July, and only in August will we see in the statistics yesterday's increase in the petrol price coming through. And we know that at this point in time, there's a R1.50 assistance from the government in terms of reduced fuel levy. That disappears in 2 months' time, which means another increase. And the petrol price has a pervasive effect on cost. If you're delivering bread, the bread comes in a truck which uses diesel or petrol, so the cost of delivery goes up. And on all the company calls I've been in recently, PEP spoke about pressures on cost. And it's not just the cost of raw materials, it's also because of supply disruption. The supply chain has been affected. It's taking a long time for goods to come from the east, for instance, to South Africa. The cost of containers has soared, the cost of shipping has soared. And this is going to affect inflation in the months to come. So we certainly are going to see inflation rising in this country. If I look at US inflation, it's soared, currently 8.3%, a level we haven't seen since the 1980s, when we also had an oil price shock. And I do think that this will come down. Most economists say that the increase in US inflation, okay, it's not transient anymore, but it's likely to come down towards the end of the year, but maybe not back to the target of 2%. So we think that US inflation may remain higher than what we've seen in recent years, but hopefully not at the 8% plus level. USA bond rates, if you go back in history, in the 1980s, just after the oil shock, there was a high inflation in America, and the bond rate went up to 15%. That fell to to just over 0.5% during COVID. It has now risen back to almost 3%. So it's certainly off the COVID lows, but those lows were artificial. That was done by the American central bank buying bonds to force the interest rates down to stimulate the economy. That has ended. And there is scope maybe for the rates to rise a bit more. Though at this stage, I don't think anybody is talking about rates going back to where they were in the 1980s. Short-term interest rates in the States also have lagged inflation. The green line here is American inflation, consumer inflation. The red line is the short-term money market rate. And even though it's risen, if I look at where inflation is, even inflation comes down from 8% to say 4%, that red line probably has to rise to 3%. So we can expect another 2% rise in short-term rates in America, which is, as I said earlier, is usually a negative for the stock market there. The same applies to Germany. Who would have thought that German inflation, the green line, the red line here, would rise to 7.9%. In fact, European inflation yesterday announced came out at 8.1% last month. The highest has been for many, many years. And off negative base, German interest rates, money market rates have been negative. We are very likely to see them rise, but they have a problem. I mean, Germany in particular imports a lot of its gas and fuel, its coal from Russia. That's going to stop. The price of fuel's gone through the roof. We're also seeing wage demands. It's not just limited to food and fuel. We've seen big wage increase demands coming from Germany. I was speaking to AECI recently. They have a subsidiary in Germany called SARB, and they said for the first time in many years, wage increases have become something to talk about. They offered 4.5% wage increase, which is unheard of in Germany, and Labour wasn't so happy with it. And then last, I just want to talk about the exchange rate, the Rand exchange rate. All of us believe that the Rand always weakens. What I've taken here is the Rand, not against the dollar. The dollar's been particularly strong, but the Rand against a basket of currencies which the Reserve Bank uses based on our trade. The dollar would be the biggest component here, but also the euro, the yen, the renminbi would come into this, and adjusted for inflation in South Africa and inflation in our trading partners. So this is not just the nominal exchange rate, this is the real exchange rate adjusted for inflation differentials. If South Africa has high inflation, you'd expect the Rand to weaken. And conversely, if our trading partners have high inflation, expect the Rand relatively to strengthen. And what is interesting is that over the years, I go back here almost 3 decades, adjusting for inflation, the Rand actually had huge ups and downs, so huge cycles, but on average has trended sideways. The Rand does not always collapse, and particularly if you're invested in inflation-linked assets to compensate for inflation differentials, the Rand actually has not been historically a bad place to invest. Now I come on to the PPS Defensive Fund. What are we trying to do in the PPS Defensive Fund? This is a lower risk fund with a target of inflation plus 4% per annum, but with lower risk than the average fund. I always believe investing, the most important thing is to try and keep the value of your investments rising faster than inflation, which means your buying power improving. You are richer, not because your money grows. If your money grows by 10% and inflation is 20%, after a year you're 10% poorer. Even though you think that you're 10% richer, you're not. I always tell the story about an aunt of mine who had a good middle-class business, which she and her late husband ran for many years. They worked very hard. They sold it some 30 years ago. She invested it in what was then the UBS, in a savings account. Very safe, very secure. You might say prudent almost. And what happened is she got a low rate of interest and she was happy because she was earning income. And after about 20 years, she bought a flat in Sea Point. After 20 years, the family got a call to say that a check to pay her levy for a flat had bounced. She'd run out of money. What had happened is her so-called prudent investing in a savings account had led to her earning less than inflation. So after 20 years of inflation, she had become poor. Not because she was stupid, well, I'll argue about whether she was stupid, not because she'd been imprudent, not because she'd lost any money. She had never lost money. It was just that inflation had slowly destroyed the buying power of her money. My first car cost me 2,000 Rand. Today, a tyre for my car costs me 2,000 Rand. The value of money will tend to decline over time in most parts of the world because of inflation. So what is most important for our clients is to make sure that the value of their savings, their hard-earned savings, keeps up and exceeds inflation. Our target is to do that by a buffer of 4% per annum, but with low risk. We use a core of fixed income assets with addition of equities. In terms of the regulations, we have a maximum of 40% of our portfolio in equities. We risk control in two ways, both strategically, in that we have less exposure to risky assets, and equities, while they may or may not give you the best return over time. Most people argue they do give you the best return over time. I'll come back to that. But we limit our exposure there. We limit our exposure to property and other asset classes also. So strategically, we control risk, and then individually we control risk. Every single asset we buy, we look at risk. If we buy a share, we look at the risk. How risky is the share we're investing? If we buy a bond, we look at how risky that particular bond might be. So if I go back in time, when African bank bonds were offering a good rate of interest, a very high rate of interest, we said that's very nice. We did not foresee African bank getting into trouble, but we said that is the wrong type of asset for our clients in a defensive type fund. So we never bought African bank bonds. And then as a philosophy, we stick with it rigorously. As far as we can, we may make mistakes from time to time, but we try and avoid individual assets which are risky. Steinoff shares were not in the portfolio. The emphasis is on adding value through asset allocation, and the fund is designed for the more cautious clients. So who has gone to this portfolio? My mother-in-law's money is in this portfolio. She's retired. It's appropriate for her. My son, who's more adventurous, said no, he wants to experiment, and he put his money into Bitcoin a year ago. I won't say who has done better, my mother-in-law or my son, but you can work that out for yourself. On the right-hand side, I have my performance indexed in blue as a fund manager of defensive funds. The gray line is my target, which is inflation plus 4% per annum. And I want to make 2 points. One is over time, the blue line has been over many, many years. I've been doing this for more than 30 years, actually. For more than 30 years, I've returned more than inflation plus 4% per annum. And also, if you look at the blue line here, it doesn't fluctuate wildly up and down. It's a fairly smooth line. Yes, at the beginning of COVID, it did come down. But other than that, the line has been fairly smooth. I'm not trying to do plus 20% this year and then taking the risk of doing minus 20 next year. I'm trying to keep my returns stable, defensive for the more cautious client. This fund is ideal for those who are looking for living annuity, those who are retired, and just people who are generally more careful with their money. And it does not mean that the returns will be lower, though it just means we're going to be more cautious. How are we positioned currently? As I said earlier, I believe inflation is rising. And in any event, my biggest fear always is that my portfolio will not keep up with inflation. So for my mother-in-law who's retired, no longer adding to a pension fund, it's important she does not lose the money. If she loses her money, if it has because there's a stock market crash or interest rates soar, she cannot replace that money. So she has to be more cautious. So for her, as long as we keep ahead of inflation, she should be happy. So big overweight inflation-linked bonds. We also overweight nominal bonds with a return of over 10% on average on my bond portfolio. It is well above inflation. Inflation might rise further, but I think we are protected, certainly with the high yields we're getting. And I think the Reserve Bank will continue to fight against inflation. We are somewhat overweight equity. Property, I have bought a little bit in the last year or two, but it's really underweight still. I am concerned particularly about office property and the work from home and how long we will see these vacancies in offices. And then reduced money market, 5% of the money market is less than the inflation rate. If I look at asset allocation, where are we currently? Equity, domestic equity, we're 27%. I'll come back to detail that just now. listed property fairly low at 3%, fixed rate bonds at 19%, floating rate bonds at 7.9%. Those floating rate bonds are bonds which are linked to money market rates. As money market rates rise, as they will this year, the interest we earn there for our clients increases. And then inflation-linked bonds, one of my favorite assets. I would have a lot more, but there is some risk on inflation-linked assets if you don't hold to maturity. But if I hold to maturity, I'm guaranteed to earn close to 4% per annum above inflation. A very good asset for this type of portfolio. Money market quite small at 2%. The bulk of the portfolio is domestic, 81%. Foreign equity, 9%. The fixed rate bonds actually is a very short-term bond denominated in dollars, where I'm earning about 5% per annum in dollars, and there's quite low risk. And then foreign money market, 5%. But the majority of the portfolio in South Africa, I'm not taking on currency risk. There is a place for offshore assets. I have a daughter who is studying overseas, and that is costing me in dollars. So for that in particular, I've put money into an offshore dollar investment vehicle. But for myself, where I'm living in South Africa, for my mother-in-law, whose expenses are in South Africa, my focus is mainly on getting a return in South Africa of inflation plus 4% per annum. If I look at the detail of where we invested in equities, I have here the top 10 shares. And you might say this is a boring selection. Let me go through them. Our biggest investment at 6.3% is Remgro. Now, many people say, well, Remgro isn't a bit of a sleepy investment trust. It is an investment trust, which for me is great. I can buy the company at a discount of almost 30% to the value of the investments it owns. I like bargains. It's great value. And what are those investments? The biggest investment is a controlling stake in Mediclinic, South Africa's biggest listed hospital company, with hospitals in South Africa, in Switzerland, and the Middle East. Just announced very good results, good potential. And while Mediclinic also would be a nice part of my portfolio, people always get sick. It's not a cyclical business. So even if we have recession in Europe, Switzerland may or may not be affected, but you have recession in South Africa, Middle East. The Middle East at the moment with oil revenues is booming. People get sick irrespective of the economy. The second biggest investment owned by Rembrandt is CIVH, Dark Fiber Africa. They're the biggest owner of fiber networks in this country. During COVID, we've all probably been using their product. They do both home fiber, and they also do the backbone, the big fiber connections that connect Cape Town, Joburg, and other territories. Most service providers would use their network as the backbone of their distribution of signal. A great industry and growing very nicely. So that's Rembrandt. MTN, the mobile telecommunication company. I like that. Also, today, communication is very important. And there's also growth here. This is both a combination of stable earnings and growth. They've recently been awarded a license for banking in Nigeria, Africa's most populous country, with a really poor banking system. Most people in Nigeria don't have a bank account. They're going to offer banking over a mobile phone. There's a massive potential here, which I don't think is fully in the price. So another of my favorite investments, Tungela Coal. This we put in quite recently, 5% of the portfolio. Actually, it was 2.5% of the portfolio, but because the price has doubled, recently the percentage exposure doubled. This is pumping out cash at the moment. I know it's not a popular investment area, but people need energy, and until we can replace coal with green energy, they have a place in the world. It's on a potential yield of 46%, 2 times earnings at current coal price. The coal price obviously won't remain this elevated for long, but certainly the cash flows at the moment are great and compensates for the short life of the business. Adcock Ingram, an ideal top investment for this portfolio. Adcock, pharmaceutical company, During COVID, they didn't have such a great time. And the reason for that, surprisingly, or not surprisingly, was that during COVID, most of us were wearing masks. So we were not getting seasonal flu. Now that people are wearing masks to a lesser degree, flu season this year probably will be bigger, and they will sell more of their flu remedies. They also sell drips and other medical equipment. A non-cyclical business. People get sick, as I said earlier, in good times and bad times. 10 times earnings, 4.5% nice dividend yield. Udaco, industrial supply company, supplies ball bearings, conveyor belts, and similar. 8 times earnings, been a very good performer for the portfolio. And one advantage we have as a boutique, we have 20 billion rand assets under management. We can still invest in a company like Udaco, a medium cap company, and it's meaningful to our clients. If you're a 500 billion rand gorilla in the investment industry, you're more or less limited to investing in the top 40 shares. We have the flexibility that we can invest in medium cap shares like Adcock and Udaco, and it's still meaningful to our portfolios. PP Cement, even though infrastructure spending has been very slow in coming back in this country, I think it will come back. In the meantime, we're buying it on very, very cheap prices. Anglo-American, benefiting from the commodity boom. There is a question how long the commodity boom will last. Exxaro, again, benefiting from a high coal price, Old Mutual, and Anheuser-Busch. So we look for stable type companies, companies which either are protected by having very low price to earnings, or with a business model like MediClinic or Dark Fiber Africa and Rembrandt or Adcock Ingram, where the earnings stream is continuous through good and bad times to give us stable or defensive type earnings for our clients, so that our portfolios are stable. And stable shares don't always have to be low return. If I look at some of our share returns last year, PP Cement was up 266%. Who says stable must be boring? MPAC, the packaging company, up 153%. RB Platinum, until we sold it, up 145%. Lewis, the furniture group, up 113%, and then Sasfin up 93% last year, and a lot more up this year. If I look at our returns for the PPS Defensive Fund, it's been going since October 2018. We don't yet have a 5-year track record, but we'll get there next year. I compare our returns for Defensive Fund against the average of our peers in the unit trust industry. Over 1 year to end of April, PPS Defensive did 12.4% compared to the average of our competitors in the category of 7%. Over 3 years, we did 8.6% per annum compared to our competitors of 6.6%. That's through the difficult COVID periods. And where do returns come from? We had a reasonable weighting in shares at the right time. Inflation in bonds have done well for us, certainly in the last year, and we increased it during COVID. So we missed out some of the poorer returns in 3 years ago during the first year of COVID, and have benefited in the last 2 years. And then some of the small carriers we look at, like preference shares, only 2% of the portfolio, but last year they did 42%. So really, we mix through all the asset classes. We don't limit ourselves only to equities. We try through a balance of asset classes to get defensive, stable type of returns for our client and 4% above inflation. What is our competitive advantage? We use all the major asset classes. There's a fund manager with over 30 years of real investment experience managing funds for the more cautious type of client, been through the ups and downs, made the mistakes. Sasfin itself has a total investment heritage of 100 years. We have agility because we are a boutique, 20 billion rand of assets. We can still go into the medium cap shares. We focus on delivering inflation plus with low risk, and the proof lies in the track record. Last year, we won a Morningstar Award for the best fund in the category, cautious or stable type funds, in which the PPS Defensive Fund is. The PPS Defensive Fund follows the same investment pattern as all our other cautious funds. It does not yet have a 5-year track record to qualify for the award, but is run on the same basis. So for any of your clients who are cautious, who are uncertain, and certainly those who are close to retirement or looking to invest in retirement annuity, in a living annuity, the PPS Defensive Fund is the ideal building block for your portfolio. Thank you very much.
Thanks very much, Errol, for sharing those valuable insights and thoughts on pertinent issues in the market. I think there's been a number of questions. I'll probably start off with regards to ILBs. There's been a number of questions on this topic specifically. So the first question is, does the perceived low liquidity of ILBs worry you at all? It seems to be a concern for some fund managers. And probably related to that as well is whether or not you see ILBs still offering value at all, and how that asset class will perform if inflation continues to increase or to decrease sharply. Your thoughts on that, Errol?
Okay, inflation-linked bonds. Okay, the liquidity is not as good as they are for fixed-rate bonds, but they're adequate. As a 20 billion rand boutique, if you want to sell R1 billion with inflation-linked bonds, all our inflation-linked bonds are either government inflation-linked bonds with good liquidity, and some small amounts in the major banks inflation-linked bonds. I would say I could set out all the inflation-linked bonds in the PPS Defensive Fund in a day, maybe a few days at most. I'm certainly not concerned about liquidity, given the size. And on a 20 billion rand book, we can do that. Going forward, I don't really care whether inflation goes up or down. My target is inflation +4, and I'm more or less getting that at a hold to maturity from the inflation-linked bonds. My expectation, rising inflation, means the yield or the return we report to clients will go up optically. That's partly because inflation is going up, and maybe the clients will feel better because of that, but I don't really care. If inflation is 0 and I earn 4% +0 from my inflation linkers, I'm happy with that 4% because our clients' cost of living will go up to 0 at that stage. Similarly, inflation does go up to 15%, and I'm earning 15 +4 is 19%. I'll be more happy or less happy. As long as we hold to maturity, we'll get that inflation +4. And I would think even over a year or two, I normally take a 3-year time horizon, we're going to get close to CPI +4. The risks here are not that high. It's an ideal asset for this type of fund. I love inflation linkers and would have more even if it wasn't for concentration risk.
Thanks very much for that share, Errol. One more question, I think. It's been a difficult year. I think we're all aware of that. There's been challenges upon challenges, from COVID to the war, to now the question around rates and inflation. It seems very daunting and ominous out there in the market. What are the positives that you're taking out and looking forward to, going forward in the market?
Well, the positives I'm looking forward to. If you look at the positives, number one is South Africa has the advantage of being a commodity producer, and we're benefiting from a very nice commodity boom, particularly for coal, to less extent for iron ore and platinum metals. And that is providing us with money so the government can pay social grants, and there can be some economic growth. In fact, we are a better place than Germany, for instance. We're more stable. I always say, I hope it never happens, but if Putin ever presses that red button, I'd rather be on the southern tip of Africa than in the northern hemisphere. And I'd say we've got some very good companies in South Africa, well-run companies. We're going to show good growth this year. So I can still see us having reasonable returns from our equity portfolio. Our bond portfolio, by world terms, we're getting very good returns from our bonds. I think in real terms, I think only Indonesia, I read somewhere recently, had higher rates than we had in real terms. So I'm looking for a place in the world to invest our higher yields here, and our expected growth from our companies in the short term is probably better than elsewhere in the world. So those would be my positive factors.
Wonderful. Probably one last question, Errol. And this is obviously, the global market's been hammered quite significantly, but the question goes around, what's your view around increasing offshore equity allocation, and whether or not valuations is the most important factor.
Okay, on equities, I think world equities in a time of rising interest rates, until interest rates stop rising, equities are unlikely to perform. And I also think economic growth will slow. The TINA, people say there is no, for equities, there is TINA, there is no alternative. You have to buy equities. Maybe, equities are the long-term do rise. I don't know if any of you know that, but Japan, this Japanese stock market, the Nikkei, peaked in December 1989. It still has not gone back to the level it was in December 89. So share markets do go up over time, but sometimes it can take many years. In the case of Japan, what's it? Over 30 years, it still hasn't gone back to its previous peak. People say there's no alternative to equities, maybe over the very long term, over 100 years. Over 5 years, I could see world equities underperforming. And also at the term, there is no alternative to equities. There was no alternative. When interest rates were zero in Europe and America, your alternative was earning nothing on fixed interest assets. There is an alternative now, and that is you can now earn 3% on American bonds, where previously you were earning 0.6%. There is an alternative to equity. So I say, while interest rates are rising, there's an alternative. Stock market valuations could come down. So I'm not over-enthusiastic about world equity markets. I'm not forecasting a crash. We already had a bear market in the S&P. Technically, we had a 20% decline from peak. So technically, the S&P has gone into bear market. Same for NASDAQ. I don't see it collapsing, but who knows? In terms of allocation, if I take money offshore, I don't have to invest in equity. There's an alternative now. I can start thinking about US bonds at 3% for 10 years. I'm not sure it's quite there yet, but certainly there is some modicum of value coming back into alternative assets offshore. And as I said, if I can get better returns in South Africa, why invest offshore unless you have a liability, you want to go live offshore yourself at some stage, and your future expense will be dollars, in which case it makes sense to invest offshore. But for my clients in South Africa, I am less enthusiastic about offshore at this point in time. That could change. Thank you.
Thanks very much, Errol. Just one last question. I'm sure this person posed this question in response to yesterday's petrol price hikes. And I know it's probably on top of mind for many. But just how long do you think government can sustain the petrol price relief, and in terms of the country affording that sort of tax relief?
Okay, I think they announced that the 150 relief will fall to 75% next month and then to zero in August. So that's the answer there. One thing I do believe is that government cannot interfere with price. Price controls don't work. Turkey tried that. It didn't work. Venezuela's tried it. Cuba's tried it. It can't work. In fact, the pricing mechanism is good. If the price of petrol goes up, people should use less petrol. They should try and economize on petrol. So government cannot afford to subsidize for much longer. Otherwise, we're going to go into hyperinflation, or we have to have big tax increases elsewhere to compensate.
Most definitely. Thanks so much, Errol. I mean, we've covered most of the questions that come through. From our side, it's been an absolute pleasure to gain your valuable insights and wisdom shared, not only on the fund, but the markets as well. It's been highly informative. So, thank you from our side for a wonderful session. And I bid everyone farewell. Thank you very much.